Assalamualaikum everyone, and welcome to episode 2 of Wall Street to Bay Street, Sunday Chai with Sharia Portfolio Canada, where we recap the market events from the past week and discuss some of the news and trends that are going on right now. My name is Nadeem Mia.
And my name is Shamil. I hope you guys got your chai. I know I do. Nadeem, let's see yours.
I got green tea today.
Oh, look at that. We got our chai ready to go. So let's get right into it and kind of discuss some of the market recap from the previous week. So, first off, we just want to go over the indexes really quick. So the TSX actually ended off at 20,138, and that's up 0.47% over the last week. The S&P 500 closed at 4,247, and that's up about 0.7% from the last week. The Dow Jones closed at about 34,480, and that's down 0.34% over the last week. And lastly, the Nasdaq closed at 14,069, and that's up about 1.72% over the last week. So some really exciting developments. And, for US and Canadian viewers, the Canadian to US rate at the time of filming this is 0.8224. So that's a quick recap of the week we've had. And I guess one of the main topics that, have been really coming up with our clients and just that's been going around generally is the topic of inflation. So Nadeem, do you have any thoughts on kind of what's going on in terms of inflation?
Sure, yeah. I mean, we had news this week, some inflation numbers in the US came out. US CPI monthly came out at plus 0.6% plus. The consensus out there was 0.4%. So it did come in a little bit higher than expected. Over the past 12 months, that translated into an inflation rate that rose to 5%. So in other words, prices, from this time last year, we're up 5%. Now this number is somewhat distorted because we are the base time was the pandemic when everything was kind of in a lockdown mode. But the debate really is about, is this transitory, meaning is this short-lived, or is this something perpetual and longer term that we're going to have to deal with when it comes to inflation? So, there are two camps obviously out there. The U.S. Federal Reserve, which is obviously the U.S. central bank, they're right now in the transitory camp where they feel that inflation is not a huge concern at the moment. And the reason for that is that there's, citing supply shocks that are out there, some production bottlenecks that they think that, will get resolved, in short time. They also are citing a rebounding economy, again, coming off from, a period where, the economy was virtually shut down. So what they're saying is that, yes, this is to be expected. At the same time, of course, recent events, vaccine rollouts, have been, getting people to get life back to normal. And in some cases, they're spending a little bit more than what they used to because they haven't been spending over, much for the past, 10, 12 months. So all that. And then at the same time, if you take a look at the CPI number that came out, about a third of that came from basically the auto market, used cars and trucks. And so kind of saying, well, you know what, again, this is the transitory camp, meaning the folks out there, the U.S. Federal Reserve and some of the other market participants that might think that, this is not going to be an ongoing problem. Of course, on the other side of the fence, you have the people that are a little bit more fearful of inflation, and they think that this might be more of a perpetual thing. And for that, some of the reasons that they cite for that is the cost of the recent, the well-documented, should I say, $1.9 trillion stimulus COVID relief package that Joe Biden signed in March. Again, just stimulating the economy, putting more money out there. Of course, there's talks about a potential infrastructure bill that's in the trillions as well. It's again creating more of a stimulus into the market. So basically, more money into the system, and at the same time, even though this last CPI number was all about, like we had a big jump in auto, we also saw, rise in prices in furniture, airfare, labor costs, material. So it wasn't just, used cars and trucks, there were some other prices as well. But specifically, as far as what the markets did, or at least what the markets reacted when these numbers came out, the major averages, like you just quoted us. They were up for the week, and even on that day, they did trade higher, and the S&P now today is sitting at an all-time high. Even tech stocks, outperformed cyclical names when these numbers came out. And what we've seen, as you saw for the week, the Nasdaq, which is very tech heavy, outperformed the Dow Jones Industrial, which tends to be a little bit more old economy and cyclical names. And so, it's very unusual that will that happen. Normally, what we've seen is growth stocks kind of get hit when there's been fears of inflation. Not to say that that's the only reason, but and at least for now, what we're starting to see is even the bond market, which really didn't have a strong reaction at that. There was no dramatic reaction. In fact, the U.S. 10-year yield dropped below 1.5%, and we're starting to see some kind of stabilization in that rate.
Awesome. Yeah, that's some really interesting information. And kind of piggybacking off that, I think the next thing that I think one of people's favorite topics is taxation. So there's been some developments in kind of the tax rates and the global minimum tax rates. So do you want to kind of elaborate a little more on that?
Sure, yeah. So just last weekend and into this weekend, G7 countries actually reached an agreement, or reportedly reached an agreement in principle on a global minimum taxation. And, and this was basically discussions from the OECD. So what the deal really is trying to do is trying to require that companies pay at least a 15% tax on income, and and be taxed where you're doing business, not necessarily where you're headquartered. So I mean, what this does, it prevents companies from shifting to low tax jurisdictions, or at least headquarter themselves into low tax jurisdictions. And so by doing this, it does I guess um, avert those companies from just seeking low tax jurisdiction just to kind of hide out there. In return for this, the U.S. Wanted European nations and others to drop the digital service tax that basically targeted a lot of the big American tech companies. Of course, there's still a long road ahead in terms of this eventually being, put to practice. No formal deal has been done. Obviously, we have to see this go through the various levels of government, U.S. Congress, Parliament, etc. And then, I guess the next step would be, the G20 nations, and possibly getting them on board.
Awesome. Yeah, thank you for that. And I guess, kind of going into the next topic here, there's been some really cool information north of the border. So why don't you kind of walk us through that as well?
Yeah, I wouldn't know if it's cool information, because it wasn't good information. And I guess what you're talking about is the Keystone Pipeline got officially canceled.
Yeah.
So TC Energy, which is the old TransCanada pipeline company, officially canceled the Keystone Pipeline after President Joe Biden had revoked the permit earlier this year. So, this was a pipeline that was expected to carry something like over 830,000 barrels of oil per day from the Alberta oil sands into U.S. refineries. It was a project that was constantly delayed for the past 12 years. And, we got a lot of oppositions from environmentalists, the aberrational people, as well as, other landowners. It doesn't come as a huge surprise. I think what if you saw the shares of TC Energy on the day that they announced this, it wasn't a dramatic move of any sort. So, kind of, I would say probably not the best kept secret in the world, but it tended to be more of a formality than anything.
Sweet. And kind of our last topic for the day, one of the most exciting sectors, I'd say. And there's been some news in the technology sector in Washington. So why don't you kind of finish off with that?
Yeah, I mean, this was a bipartisan bill. It was called the U.S. Innovation and Competition Act. And in some cases, this was an act that, again, both sides of the aisles, Republicans and Democrats, came up with this bill. And I guess it's kind of centered around, China, or at least, keeping itself competitive versus China. So it's a $250 billion package reportedly. And it's aimed at, challenging China's technological ambitions. And the U.S. Senate has passed it, but it still has to go through House. And the deals of the bill are basically they're looking at $190 billion for cutting edge science and artificial intelligence, and this is via the National Science Foundation. About 54 billion would is going towards U.S. production into semiconductors and telecommunication equipment. We've seen a lot of news on the semiconductor industry and how there's been a lot of supply constraints. So again, kind of trying to alleviate that. And as far as what's going on, according to the U.S. Office of Management and Budget, in recent years, R&D has accounted for less than 0.3%, 3% of government spending. So this is kind of highly unusual, or I should say, I mean, it's a good thing that the government is now starting to kind of redeploy assets back into technology and research and development.
Awesome. Yeah, so that's kind of all we had for today. Thank you, Nadeem, for your thoughts. And thank you, everyone, for kind of listening in. And if you do have any other questions that you'd like to see answered on the show, feel free to leave them in the comments below. If you'd like to book an appointment with any of our advisors, click on the link in our bio or below. And feel free to download our app on the App Store today. And also, lastly, please remember to like, follow, share. And yeah, hopefully you guys enjoyed our chai today, and hopefully you guys had a good chai meeting and listening to Nadeem. So yeah, thank you so much, guys, and we'll see you guys next week.
Thank you, guys. Assalamu alaikum.
Bye.
Nadeem Mian, Portfolio Manager, registered as an advising representative, and Shamil Devji, Financial Advisor, registered as a dealing representative with Sharia Portfolio Canada Inc., a portfolio manager registered in the provinces of Ontario, British Columbia, and Alberta. Their opinions and statements expressed in this show are their personal opinions and do not necessarily reflect those of Sharia Portfolio. They are effective as of the date of this broadcast only and are subject to change. This discussion is for general information purposes only and is not investment advice.